I'm going to spend the rest of the time on giving you a quick lesson in finance and investing, what I call retirement investing 101. I'm really going to cover 4 topics: asset classes, understanding risk and returns and how to think about that, mutual funds, what are they, which ones to select. I mentioned earlier, I'll give you some guidance on that. And then understanding and minimizing fees. The fees are kind of the hidden underbelly of the financial services world. So that's the plan for the rest. So the first thing to understand is, this is kind of a Wall Street term, this notion of asset classes. It's a fancy way of saying different investment assets. You could think of as stocks, bonds, and savings, or equities, debt, and cash. And you could think of as cash and savings as CDs, treasury bills, basically anything that's really safe but yields very little. So these are different asset classes. And not surprisingly, there's a direct relationship between the amount of risk you take and the returns you can expect over time. And I use the word expect because there's no guarantee on these things. So in general, as you all probably have some sense, stocks have a lot of risk, but the expected returns are high. Bonds are in the middle, and the returns are in the middle, and then cash. We all love the riskiness of cash, which is, say, there's no risk, FDIC insurance and all that, but the returns you get are very, very low. So the reason for that range in that last column is the right-hand side is what these returns have been historically over the past 100 years or so. Stocks have averaged 10%, bonds 6%, cash 3%. For a variety of reasons, economists believe, I do too, I think this is right, these returns are going to be lower going forward. There are a variety of macroeconomic reasons why returns are lowering. So that's what's on the left. I think a more reasonable number to assume going forward for these asset classes. There's other ways to invest money. I'm not going to talk about them. Real estate, commercial real estate, I think is a perfectly reasonable investment. And derivatives, that's what got us into trouble in the financial crisis. I don't think it's a great investment for anybody. But these are different asset classes with different characteristics about them. Asset allocation is another piece of Wall Street jargon. It just means, what's the mix? What's your pie chart look like for how you combine stocks, bonds, and cash? And the mix you take determines what the expected returns you're going to get overall are. Everybody follow? So you may hear people say, what's your asset allocation? Rebalancing your asset allocation. You may hear terms like that. That's what it refers to. It's the mix of stocks, bonds, and cash. I should mention you could think of their sub-asset classes. So like with stocks, there's international stocks, there's small stocks, there's big stocks. So there's different sub-asset classes, and the characteristics of them are a little bit different. With bonds, there's different kinds of bonds. There's government bonds and junk bonds and corporate bonds and long-term bonds and short-term bonds, etc. So there's all kinds of subclasses. Socially responsible investing. My view is you pay a small price, but not a large price. So just to define that, people aren't sure, it refers to either screening in for certain positive attributes you want, or screening out for certain negative attributes you don't want to invest in, whatever is your thing, guns, military, environment, whatever you care about. So that's what it is. There are funds that do socially responsible investing. I don't recommend you do any of them. I think we all have our political views, and I'm very sympathetic to it, but I think it's a bad idea because I think it has no effect on what you're trying to accomplish, and I think you'll earn slightly higher investment returns if you invested in more traditional index funds. And then with the slightly higher returns, I would donate the excess to charity that you care about, and I think your impact would be bigger. But having said that, there are options to do that, and if you're interested, I can walk you through more of it afterward. Part of the issue is it's not so easy to do with international stocks, which should be part of your portfolio, and it's not so easy to do with bonds, because there are no kind of socially screened bond funds like there are with stocks. But if you want to do stocks and you agree with the screening criteria that the fund manager uses, there are options to do it. My ex-wife was involved in the South African anti-apartheid movement in the early 80s, and she was one of the early people who did this kind of stuff when it related to South Africa. So I have a lot of history with it. I have a lot of sympathy for that, but I just don't think that's the most effective way to accomplish that. Investment risk. my experience is this is a really hard concept for people. Sounds easy. We all have some sense stocks go up and down, but it's really hard to process. And it's very abstract, it's complicated, it's scary. We all filled with regret. You know, we invest in the stock market, it goes down, we're filled with regret. We sell the stock market and it goes up, we're filled with regret. You can't win. You're filled with regret no matter what you do. It's an emotional roller coaster for people. So it's very difficult to process for everybody. You're not alone in that feeling. I do this for a living. I have the same feelings of regret as everybody. Why didn't I think of that yesterday, right? Part of the problem is if you take too little risk, it's very costly over a lifetime because you're going to end up over a lifetime with, and I'll show you a picture of this in a minute, with less money than you otherwise would. And it means either you need to save more to make up or you're going to have less to spend in retirement. So taking too little risk, stuffing all your money in a bank account is not a great solution. This notion that people on Wall Street, they're monitoring your portfolio and they're doing nothing. There's no monitoring to be done. So particularly when the stock market crashes, my firm advice is don't look. And if you don't need the money anytime soon, just don't look. I think that's the, the best thing is to do nothing. If you have it invested in the asset allocation that makes sense for you, there's nothing to change every day. And I'm going to give you some guidance on how to do that in a minute. Like, that's what I tell my daughters. So they have, as I said, they each have a Roth IRA. And, I think their mentality is they never look. They don't want to know when it goes up. They don't want to know. In their mind, that money's gone, right? They're 25 and 30. That money's gone. They don't know. They don't care. When they're 70, they'll look again, and they'll be surprised how much is there because they didn't panic and they didn't touch the money over all these years. The next bullet, this gets back to the question of annuities and Social Security and pension. When you have a reliable income, either because you're still working or because you have Social Security, you have an annuity, you have pension, that serves as a lot of ballast to mitigate the risk. And so the more reliable income you have, the riskier you want to be on your investing. And so that's why when you're young and you got a lifetime of an income ahead of you, that amount of income you're going to earn over your lifetime is going to dwarf any fluctuations in your savings balance. And so you want to invest aggressively. When you don't have reliable income, then it's trickier because you need this money and you're trying to balance getting investment returns with the safety of keeping that money. But if you have reliable income, then you want to take more risk than you otherwise would. And again, that pertains to whether you're working and you're young or you're in retirement and you have. So if you have a pension, that's why my instinct is I would not convert the pension to a lump sum. I would keep it as a pension because that allows you to invest your other money much more aggressively. The other thing is, and we live in the short run, so we have to go to sleep every night, of course, but we need to have a long-term horizon when we're thinking about this money. And over the long term, and I'm going to show you a picture in a minute, you can see that the risk is mitigated. These are short-term fluctuations, so it's easy to say, have a long-term horizon. I know it's hard to do. And to compound that, you face these other risks that you need to deal with in retirement. One, we talked about life expectancy. You just don't know when you're going to die. That's a hard one to deal with because you can't plan. But there's also inflation. If you invest too conservatively, inflation is going to eat away at your standard of living. And it's going to be like that drip in a pipe that, 5 years later, the ceiling collapsed in my basement. It was dripping for 5 years, but eventually it collapsed. You're not going to notice it for a long time. So inflation is very tough to manage because it happens slowly. But if you invest too conservatively, put all your money in the bank, then you're not going to exceed the rate of inflation. So here's a picture of what I'm talking about. So let me explain this chart. So I somewhat arbitrarily started at 1980 through the end of 2018 because this is roughly a lifetime of investing for most people. And there are 4 asset classes here. The blue is stocks, the green are long-term bonds, the whatever that color is, the burgundy is a savings account, you can think of that, and the orange is inflation. So there's a lot of things to observe here. The first I'd point out is, if you stuff all your money in a savings account, you're just going to keep up with inflation. That's roughly what happens over long periods. The second thing I'd observe is the blue line. It's very wavy. It's terrorizing in some ways. It's very scary. So this dip was when the internet stocks first crashed around then. This was the financial crisis we're all familiar with. This is a huge dip. This was like, what, a 40% dip from the top to the bottom? Huge. This is a huge amount. And then last year, the stock market went down for the first time in 10 years. So the stock market's gone up every year since the financial crisis. So you can see it didn't take long to recover from the pre-financial crisis. So this is my point about the long term. You're much, much better off in stocks than you are in anything else. But you need to ride that roller coaster, which we've all been through it several times. And it isn't fun. And we think, is this time like the others? Is it going to recover? We don't know. But the last thing you want to do, getting back to your question earlier, is you don't want to sell here. You don't want to panic right here. This is not what you want. You don't want to sell here, et cetera, because look what happens. And the best way to avoid that is just don't look. Just don't do anything. And so the difference over a lifetime of investing is huge between investing in the stock market and not. Bonds, I think, should be an important part of your investment portfolio, particularly as you move into retirement. So when you're young, when you're my daughters, 100% blue, basically, for obvious reasons you can see. When you're me, instead of my daughters, it should be a mix of stocks and bonds. Because one of the things is they balance each other out. The risks balance each other out a little bit. They don't always. Like you can see in 2018, they both went down. So the correlation there was the same, but that's not always the case. So like when the stock market crashed in 2008, you can see the bond market, and this was another way of saying this is when interest rates went close to zero. That's why the bond market went up so much, because interest rates went down. So bonds are important to have as part of, particularly when you get older. It serves as ballast to the variation in the stocks. Other questions on this? So where should you invest your money? So again, you might have 2 or 3 pots of money, your taxable savings, your 401k, 1 or 2 IRAs, etc. In my view, put 100% of your money in mutual funds of various sorts. Don't buy individual stocks. It's a bad idea. Don't buy individual bonds. So first, do people understand what a mutual fund is and how it works? Does everybody understand, or you want me to explain that? Yeah, so a mutual fund is a pooled fund of money from retail investors, from consumers like you and me. Instead of us going out and researching stocks or bonds and buying 50 different stocks to have a diversified basket, you don't do any of that. So a mutual fund company like Vanguard or Fidelity or T. Rowe Price, Charles Schwab, they have these, smart Harvard MBA guys. They pool the money and invest it in the asset class that you want: stocks, bonds, real estate, etc. So it's diversified, you have their expertise, it's simple, and it's very, very cost efficient. The fees that you're talking about, Arlene, I think there's 2 kinds of fees. There's the advisory fee that Angel's playing, and I think the fee you're talking about is the expense ratio. Every mutual fund has something called an expense ratio. That's the fee you pay whether you're doing it yourself or you're hiring somebody to do it. If you're hiring somebody to do it, you pay both fees. You pay a fee to the guy and you still pay the expense ratio. You need to understand the expense ratio you're paying. They vary greatly. Let me give you a sense of this. I love to pick on Goldman Sachs and JP Morgan. And so everybody has these target date funds. And you can see the differences are huge. Fidelity has 2 versions of it. They have something called the Freedom Fund and they have the Freedom Index. They don't advertise the Freedom Index, but they have it if you ask. And you could see that the difference between Vanguard and even Fidelity, 0.6% a year is huge over time. Huge. So I don't know why you would pay. It's not like the folks at JP Morgan are any smarter than the guys at Vanguard. They all took the same class at Harvard when they got their MBA. So you really want to pay attention to these fees. And getting back to the earlier discussion, when you're in a 401k, you cannot control your investment choices, whatever your employer offers. They may offer good ones, they may offer bad ones. But when you leave and you do an IRA, you can control where you invest the money. One more word on fees. So Angel, this is what it's costing you. So a 1% fee. Now, I don't know how many years you've been doing it, but I did this over 40 years. Basically, 1% sounds small, but after 40 years, 22% of your net worth is going to be gone in fees. It's a huge amount. Is it big over a small number of years? No, it's not a big deal. But over 40 years, these fees are huge because of the compounding effect. And so that's why they matter. You need to pay attention to them. You want to explicitly and mindfully think about your risk tolerance and your asset mix. And you can either do that on your own, or you can hire a financial planner to help you, etc. But you want to be explicit. How much risk can you tolerate? Everybody's different. There's no one answer. Just because you're a certain age, certain income, everybody's different. How much do you want to trade off sleeping well at night versus future investment returns that are going to be higher? There's no one answer for everybody. But I would encourage you to be mindful about what you do. And then you really want to set it and forget it at that point. You don't want to tinker. You don't want to panic. You just want to sit there and do nothing, as the expression goes. You don't want to make bad choices going forward. You absolutely want to minimize your fees, particularly as you go into retirement. As I said in the beginning, it's lots of small things that are going to add up to make a big difference over a lifetime. And one of the things you can control most are the investment fees that you're going to be paying. I talked about this. I recommend a target date fund for everybody for the reasons I talked about. You don't have to think about it anymore. And then lastly, as I talked about, I recommend you consolidate all your retirement accounts. And so when you're done, you really should have just one or two retirement accounts, either a single pre-tax IRA or a pre-tax and a Roth. That's all you want. And then when you take the RMDs, they're coming out of one account. If it's a tax like you were asking, if it's a non-retirement account, no problem. Vanguard has very similar accounts. The difference is for the non-retirement, they call them life strategy funds, and they have a series of them with different asset allocations. The difference is they don't auto shift over time. It's a fixed asset, it's a balance fund is really what it is. And so you can pick them, they go 80-20 to 20-80, stocks and bonds. The nice thing about them, again, is that it's a mix of four funds: U.S. international stocks, U.S. international bonds. The difference is they don't shift. They're going to be fixed at that asset allocation. So if you decide, for now, your best asset allocation is 60% stocks and 40% bonds, you would pick the life strategy fund that has that mix, and you're confident it'll stay there. Or if you decide, I think this is a perfectly reasonable thing to do, we think real estate is a good investment class, and that's not in there. You could put, making up a number, 80 to 90% of your money in that life strategy fund, and then by the Vanguards, they have a real estate investment trust index fund. So you could put 80% of your money in the life strategy and 20% in the REIT. And if you call it a REIT, they'll be really impressed when you call them on the phone because it sounds like you know what you're talking about. And then you could do that if you want, depending how much you want to get involved in this. I think it's totally fine to do 100% just in the life strategy. For taxable money, when you withdraw, you're going to pay capital gains tax if it has appreciated. There's no penalty. You don't pay Vanguard a penalty. There's no withdrawal fee. You can move the money all you want, but you'll pay capital gains if you've incurred a gain. That's one of the nice things about IRAs. When you move the money around, you don't pay capital gains on it. If you have a brokerage account somewhere else and you've invested in a bunch of stocks, right, and you decide, I want to move to Vanguard, there's two ways to move it. You could sell all those stocks and move the cash over. You're going to pay capital gains. you can just move the stocks over to Vanguard. In the old days, there would literally be paper securities, stock certificates that would go in a truck and they would deliver them to the Vanguard vault. They don't do that anymore, obviously. In that case, there's no capital gains because you haven't sold it. So your old broker will deliver the securities electronically along with the basis that they have on record for you, and then it'll be at Vanguard, and there won't be any taxable event that happened there.
Will there be a fee for making that transfer?
There will not be a Vanguard fee. It would depend on your other investment firm if they charge a fee. Typically, there's not. Everybody's different. But Vanguard nobody charges a fee to move money into them.
Thank you.
So, as I said, track and manage your spending. Unless you have a good reason, wait till age 70 to collect Social Security. I think a single premium, simple annuity can be a good idea. Never do these complex variable annuities. They're never a good idea. They only benefit the salesperson, as the expression goes. Long-term care insurance we talked about, and your investment accounts. And then I think you mentioned number 8. If it sounds too good to be true, you can be sure it is. And so that's a good sign. That's not something you want to do.